That's why it's so dark. I'm like, why is it so dark? That is that is why. Oh. Hmm. And we're live. And we're back. Good morning. Ooh, apologize. Good morning. Today is February 26th, 2022. Another beautiful Sunday morning. And I apologize for the delay this morning. I should have sent out an email a little bit earlier. I was having some trouble with my email form. I ran into some issues a few weeks ago where I deleted almost everything. And I've been working to fix it. And I think I finally got it fixed, but it did delay sending out my email this morning. So I apologize for the lack of notice. I'm sure people will keep trickling in the next couple of minutes. But thank you for joining me so far. For those of you who are here, and for those of you who are watching later on YouTube, and it doesn't matter whether or not I was on time because it's a YouTube video. But for those of you who are live here, thank you. This week, if you can see me on screen, you thought I'm kind of cold this week. It's cool. It's cool where I am today. So I'm wearing my fluffy lumberjack sweater, trying to stay warm. Hopefully wherever you are is warm and cozy and comfortable. This week I wanted to talk about knowing your market. I guess this has been my focus for the last, I'd say 2 months, to be honest, all year. Excuse me, I've been working pretty hard myself to try to know my market or know a couple of markets actually where I've been looking at investing. I don't know if it's so. For the last couple of months, the economy has been doing whatever it does. It's been up, it's been down. Gas prices have been high. Now they're kind of low. Things have been moving around a lot, and there's a lot of unpredictability, a lot of uncertainty, whatever you want to call it. I think I was reading the other day that egg prices are up a lot. I typically am not the one who does the groceries, so I don't usually see the prices of things like eggs. But my understanding is that they're up quite a bit. All sorts of things, right? So prices are moving around. Obviously, the economy is kind of shuffling, been shaken up, so to speak. And so I guess the calculus of certain things changes, right? Obviously, it's one thing to own $1 million house at a 1.5% interest rate. It's a whole nother thing to own $1 million house at a 5.5% interest rate, right? And this changes the calculus for casual buyers, casual owners, casual investors, and of course, professional investors, right? Everybody starts looking at the numbers a little bit differently. And this is where two things happen, right? I often liken real estate investing to working out, fitness, lifting weights, going to the gym, etc., etc. And one of the things about lifting weights, going to the gym, etc., is if you go to the gym today for the first time, and then you look in the mirror at the end of the day, you will see no progress. And if you go to the gym tomorrow and you do the same thing, you will see no progress. And if you do that every day this week, by the end of the week, you will see no progress. And I can't tell you when. Probably nobody can. Maybe there are some like sports science people who could, but in theory, in general, nobody can really tell you when. But if you keep going to the gym, eventually, when you look in the mirror, you'll see a person who is getting into shape, right? And then eventually a person who's in shape. And investing is similar. Now, you can look in the mirror and see a difference, right? If you own a house that you didn't own yesterday, then obviously there's a difference in your life. But you may not see the difference in your bottom line right away, right? In fact, owning that house may be costing you money, not making you money. And so it's something where you're buying a house to improve your financial situation. But then when you look at your financial statements, you don't actually have any more money. But then you keep buying houses and you keep looking at your financial statements. And I couldn't tell you exactly when, especially because a lot of it's going to depend on how good of a job you do buying those properties. But maybe after the first one, if you buy the first one right, or maybe after the third one, because it takes you a little bit of time to learn how to buy them right. But eventually, it does start affecting your bottom line. It does start showing up on your balance sheet, right? And so repetition, right? That is kind of the foundational action that is going to lead to results, right? Buy a house, wait a year, buy another house, wait 6 months, buy another house, wait 3 months, buy another house, that sort of thing. Don't always need to be houses. Obviously, investors have various criteria. Maybe you want to own, the corner stores. Maybe you want to own the laundromats. Maybe you want to own small walk-up apartments. Maybe you want to own tall elevated apartments, right? There's a diverse number of things that you can invest in real estate. But as long as there's this constant look towards acquiring more, right? And of course, don't take that to the extreme, right? I'm not saying that you must always be buying more, right? If you make it to multi-billionaire status or multi-millionaire status, whatever number makes you in your head happy, and you say, "Hey, Aaron, I'm not going to acquire more at this point." Yeah, of course, by all means, right? That's the sky is the limit. It doesn't mean that you got to go to the sky. So by all means, you've got to pick your level. But like going to the gym, it's something you want to keep doing. And even if you make it to a level of success where, hey, you know what, I've got my, I don't know, $10 million of net worth, and I'm happy with that. I don't need more than that. Okay, sure. But you should still keep doing it at that point, right? You don't need to grow from 10 to 100 if you don't want to. Donate the profits if you want, whatever it is. But to some extent, you keep going just to stay sharp, just to make sure you're maintaining those skills, just to make sure that you're on top of market knowledge, right? Make sure that you're on top of your negotiating skills. Make sure that you're maintaining relationships with realtors and brokers and the people who can help you to succeed. Because, even if you have $10 million, in theory, you could lose that, and then you're starting from scratch. And there are people who have definitely read some stories of both real estate investors and regular business people who've blown through $10 million, no problem. And a lot of the times, at least the stories that I'm reading, and there's a selection bias there because they're the ones that are getting written into books. But they may have lost that money, but they do earn it back, but only because they have or maintained skills that were able to generate or regenerate or recapture that wealth, income, etc., right? So it's not good, that should be silent. For somebody who's looking to be a real estate investor and succeed in this market where there's so much flux, knowing the market is going to be your, I guess, the pillar of your success. That's the word I'm looking for. Be the pillar of your success, right? So there's a couple components, right, to knowing your market, especially when interest rates are trending up and prices are trending down. And so it's a very precarious market, right? Certainly, you as the investor or the buyer, you don't want to buy a house today for $1 million that will be worth, let's say, $900,000, 3 months from now. And certainly in the GTA market and surrounding areas over the last 6 to 9 months, it has been very much a possibility that you could buy a house for $1 million that is now only worth $900,000, right? That is something that definitely happened around this market. So things have certainly, let me say it differently. Real estate is local, right? That's something that we've talked about in the past. Real estate is local. It's local to a market. Sometimes it's local to a neighborhood or a street within that market, right? Real estate is local. And so when I say that in Ontario, we saw price declines of 30%, understand that that is something that happened. It's a local phenomenon. So there are places where that occurred. There are also places where prices did not fall nearly as much. And there are also, I'm sure, some cases, although I can't point to any, where prices rose, right? Because real estate is local. And so understanding your market on that local level is very, very important because prices are swinging. If you pull out a magazine or a newspaper, or you're going on to some blog and it's giving you national sales data for Canada or even provincial sales data for Canada, and it's like, prices move 30% and buyer demand is down 15% and blah, 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 all these numbers. Most of them are probably not giving you enough information to make a clear judgment about any given market, right? Primarily because they're capturing too broad a data set. Usually, if you have the entire sales data for Ontario, then you're wrapping up communities like Sudbury and Sarnia with communities like Mississauga and Mississauga and North York and stuff like that, right? And those, they're not going to perform the same, right? And there are worse, quote unquote, and I'm not trying to knock Sarnia or Sudbury. I'm just saying in terms of size, scale, amount of money that's going through the area, etc. There are much worse communities than those who may perform even worse and then are skewing your numbers or your averages, right? So it's important to, when I say knowing your market, I mean you've picked perhaps a city or a region, and then you've picked perhaps a neighborhood or neighborhoods within those regions that you want to look at and you want to know and you want to understand. And so you're most likely working with a realtor, but maybe you're doing it by yourself. But either way, you're identifying those neighborhoods that you're interested in, because that's where you can actually get accurate price data, right? If I'm looking at, let's say, Mississauga, right? Mississauga is a big place. So now I'm going to narrow that down to a neighborhood in Mississauga. Maybe first I'll pick like a bigger chunk of Mississauga. So I want to stay on the east side of Mississauga, right, on the west side, right? Stay a little closer to Toronto or Etobicoke. And then maybe on that east side, I'm going to pick a neighborhood or two. So I'm going to say, Mineola, which is a small neighborhood. I'm gonna go there, and that's where I want to invest. And so now I'm going to do market research either by speaking to a realtor who specializes in that area. And realtors do, right? If you ever pay attention to like bus shelters, buses, if they have them, and billboards, you'll notice in some areas, all of the billboards and buses and bus shelters will show one or two realtors, and then you go to a new neighborhood and there will be different realtors that show up in those same ads, right? Because they've chosen their area that they are kind of focused on serving. And so you can find the realtors who are prominent in any given area, keeping in mind, of course, those realtors, the ones you're seeing on the bus shelters and the advertising, generally are consumer or retail focused, right? They're oriented towards a standard buyer, not towards an investor. But they still may be a wealth of knowledge in terms of what's happening in that market, even if they maybe aren't equipped or inclined to help you as an investor to, buy investment properties, right? You can work with an investment-oriented realtor, and they can help you get this information. Certainly with MLS access, most realtors could help you get a pretty good understanding of what is happening in that local market if they wanted to. It is going to take some of their time, to do the research. So it's probably going to depend on either your existing relationship with that realtor, right? Is this somebody who values your relationship and therefore is willing to invest a bit of time to help get you that information and hopefully generate some sales in the future, right? That's going to be. Otherwise, you're probably wanting to find somebody who already knows about that market and therefore they don't need to invest the time. They can give you that information on the hopes that you'll buy with them or whatever. And of course, you're not obligated to, right? You talk to somebody, they give you some information. It's not transactional. There's no necessarily, or it's not reciprocal, I should say. There's no necessary expectation that you now buy with them just because they told you a little bit about what's going on in the market. In that market, in that individual market, we want to identify price trends, right? Now, what do I mean by identify price trends? Well, obviously, the price can trend one way or the other. It can trend upwards, it can trend downwards, right? If the price has fallen in the last 3 months, right, every month it's gone down, we're trending downwards. And obviously, if it's done the opposite, we're trending upwards, right? We could also be trending nowhere, right? Like the price could be stagnant. It could be for the last 3 months trending nowhere and just staying the same. This is important to know. Now, there's a lot of different ways to invest in real estate, and we've covered most of them here in the past. Depending on what type of investing you're doing, price trends will be more or less important to you, right? If you're a fix and flipper, price trends are incredibly important to you. If I'm going to buy a house today and sell it in 6 months, I want to have as good an idea as possible of where that price is going to be in 6 months, right? Obviously, I have to reverse engineer my deal. I'm going to purchase a property, let's just say for $600,000, that I'm going to put $150,000 into, that I'm going to carry for 6 months at a cost of another $50,000, right? So now my 600, my 150, my 50 in carrying costs, I'm at $800,000. Now I want to make at least $100,000 profit on this thing, right? So you start doing the math. Okay, if I buy the place for 600, I've got to be able to sell it for at least 900 when I'm done in 6 months' time, right? So was I $300,000 below final ARV when I purchased the place as a flipper, right? Is going to be the first question. And then the second question is going to be, and in 6 months, will my margin, that $300,000 discount I got from potential ARV to actual purchase price, right? Will that have grown or shrunk, right? If my price is trending downwards, and I know, for the last 6 months, going back to the last 6 months, we've lost 2%, which would be a lot, but we've lost 2% sales value every month for the last 6 months, right? Which again, that would be a lot. Usually it's not quite that dramatic, right? But if then we know, right? We know now that I can't afford to do that flip on that property, right? Because my math no longer works out, right? If I'm going to lose, what would I say, 2% per month for 6 months, so I'm going to lose almost 12% value. If I had calculated my ARV was going to be $900,000 in 6 months, but I lose 12% of that, right? Then that means that my true ARV is going to be $800,000 approximately, right? Because of the 12% loss, which means now my fix and flip, which should have profited me $100,000, is going to net me $0, right? And netting you $0 on a fix and flip is really a loss because you lost 6 months of your time, right? So that's a really important market metric to understand if you're looking to flip. how is the price trending? Is it trending up? Is it trending down? And how quickly is it doing that? Now, you don't need a perfect number. You only need to be looking at the market and watching sales, month over month to see, is it going up? Is it going down? Just to get a general idea of how quickly it is doing that, right? Obviously, that's for a fix and flipper. Now, depending on the time horizon of the real estate deal that you're looking to do, price trends may be less important. They're always something you should consider, because if the price is trending down, then holding off on a purchase could potentially save you tens of thousands of dollars, right? So you want to be aware of the price trending down. Let's say if you're looking to buy and hold, even though it's going to affect your bottom line a lot less than it does that fix and flip, right? For them, that downward trend basically killed their deal, right? And if they didn't factor it in to their pricing model, they would potentially lose money. If you're looking to buy a place and hold it for the next 10, 15, 20 years, then the short-term price trends aren't affecting your bottom line or your exit strategy on that property. But what they are doing is they're constituting an opportunity cost, right? They are, if you have to take that exact same example the flipper was looking at, but now we're going to call it buy and hold, right? We're buying the property for $600,000 with an ARV of 900, right? If you're looking to buy and hold that property, and let's just say at 600, it's good. It doesn't require the reno. So 600 is all in, right? But you have that same price trend, that same 2% price loss per month, right? Then 6 months from now, that $600,000 property would obviously be about 12% cheaper, right? And so now you get that same property for $530,000 or so, right? And so that's a $70,000 savings. So understanding the way the price is trending is going to be good to know both for your it's going to be good to know for your decision making. Why is that sentence awkward? Right. Is going to be important. And again, the way that you know that is, A, you're watching the market, right? Like it's just a practice thing. B, you're talking to people who are knowledgeable and who are watching the market. So finding market experts, maybe realtors who are active in that area, who specialize in that neighborhood, and who have that market data. Remember, you can get this information from any realtor. It's just a question of whether they want to take the time to research that specific neighborhood and know the information, or whether that's knowledge that they already have because that's somewhere that they specialize, right? And you use that to identify price trends, right? So that you can make longer term decisions or more strategic decisions about when to buy, right? If you're comparing two neighborhoods, for example, right? And one neighborhood has a price that has been trending up and one neighborhood has a price that's been trending down, then to me, there's two major questions. The first one is, why is this one going up and this one going down? Like, what is that difference there, right? Obviously, if you could figure out what factors make this neighborhood go up and this neighborhood go down, that's a very powerful insight to have, right? But the second question is, well, where am I going to place my capital, right? If I've got my $100,000 down payment or 50 or 200 or whatever, right? My number is, am I looking to put it in the market where prices are falling or stagnating, or am I looking to put it in the one where they're growing? Now, keeping in mind, this is a short term, right? This is a short term metric, price trends. It's not a long term. So this is, 3 months, 6 months, maybe a year, right? Looking out further than that, these things become less important just because you can't really predict how prices will trend too far out into the future, right? There's a longer term trend, which is much more macro. And, right, what I said when I started talking about this is prices and price trends are local, right? When you hear, housing prices fell 30% in Ontario, that's, counting places where prices fell 60% against places where prices fell 15%, and then putting them together to say prices fell 30%, right? And really, it's misrepresentation. It's a misrepresentation of what is really going on, right? The longer term trends, actually, they can be aggregated or they can be generalized across broader regions because they tend to be much more gradual and much more all-inclusive, if you will. They tend to touch everything. Perfect examples, if we rewind 4 or 5 years, maybe 2000, let's call it 20, wow, that was 6 years ago, 2017. Housing prices were obviously on the increase, and they were on the increase everywhere, right? That was a broad trend, right? Really low interest rates were pushing up consumer demand, coupled with a low supply of housing, which meant there was low supply, high demand, low interest rates, which meant people could afford to pay more, so they were bidding up the prices on things. Prices were trending upwards, right? And that happened across the market, right? And you saw, sure, because real estate is local, there's always this local effect, right? We definitely saw the hottest markets, if you will, emerge, downtown core, for example, suburbs of Toronto, for example. Then you saw commuter enclaves, places like Guelph and KWC in London start to increase in value. And then eventually you see, the Sarnias and the Sudburys and the Windsors and everywhere else increase in value, because the local still has an effect in terms of what happens first and where it happens and where it has the most dramatic impact. But the effect is broad and diffuse across everywhere, right? It spreads out because the prices just get pushed up and then people go somewhere else, and et cetera, et cetera. So there are those broader trends which you can more rely on to be accurate without getting as local, right? So a perfect example, today, interest rates are, I believe, 5.5% bank rate. Which means that you may pay anywhere from around 5.5% for a mortgage up to around 7 or 8% if you've got really bad credit. And so those are having an impact on housing prices. Obviously, it's more or less the opposite of the situation in 2017. High, although not super high, just higher interest rates are squeezing people's buying power. That squeeze in buying power is reducing the number of buyers. There are now less buyers and more supply, right? Because builders responded to the high prices, so they've been building stuff. So now there's more supply and there's less buyers in the market than there were before. And those buyers have less financing. So they are less willing to bid up the prices on the properties. And so the prices are falling, right? Now, that interest rate, which is a macro effect, right, affects the whole country in this case, that interest rate is not going to stay high forever, right? High interest rates are bad for everybody except for lenders, more or less. I mean, that's not entirely true. And interest rates, just like a really quick history lesson here, interest rates are supposed to be set by the free market. What's supposed to happen is, and I'm just going to pick on some names here that I see on the screen. Sean, right, is supposed to work hard, save up $1 million. Maybe he wins the lottery. Maybe he inherits it from daddy. Doesn't really matter. Somehow Sean gets $1 million, right? And he doesn't need that $1 million. So he starts looking for opportunities to make that $1 million work for him. And so I come along and I say, hey, Sean, I'm a bright young man, and I'm gonna go reinvest in real estate. And look at this, I can get this return, I can get that return, I can do really well. And Sean says, you know what? Hey, look, I don't know about all that. I don't want to deal with all that risk. But if you can guarantee me you'll give me back 5% per year, 5%, I will lend you whatever it is, $200,000, $1 million, whatever the number is, right? And that's how interest rates are supposed to be set. And of course, I go and I shop around because I'm not, okay, so Sean's offering me 5, but maybe Armando's going to offer me 4.5 or whatever. And through a free market, that's how interest rates are established. We don't live in a free market. We have an established central bank in Canada. This is a very common practice all over the world. It is communism. There's no question about it. You can actually read, I believe it's Marx's manifesto, where he says that a central bank is an important component that needs to be established before you can have communism in a society. It is what it is. And I don't say that as some doom and gloom, oh, hick America, oh, the communists are coming. I just mean, if you look at the history, that is what the thing is. And It's a bad institution. And I wish that Canadian politics, or politics in general, that people understood both the history of what they're dealing with and also just the kind of social economic context of the things they're dealing with. Because people really would not be cool with a lot of things our government does if they understood, but they don't understand. So now you do understand. Do with that what you will. But that interest rate that the Bank of Canada sets, right, is not really good for anybody, because there's no free market, right? If there was a free market, then Sean would always want to get more, right? Sean would always want to get more, a higher interest rate if he could, because it's better for him. It's his bottom line, right? Because of the way our market works, that's not really what happens. So it's not in his favor. It's not particularly in anybody's favor to have high interest rates. Even the banks don't particularly like it because they don't get to charge a higher profit, because the way our banking system is set up, again, it's communism, is those banks aren't lending their money, right? In Canadian society, when RBC or whoever lends out money, they're not Sean from my scenario who worked hard to save up money. They're a communist organization who is in partnership with the government, and they literally, to write you a debt, they borrow money from the Bank of Canada. That's how they do it. So they don't have money to give you. They get it from the Bank of Canada. And the mechanism that they use is they borrow it from the Bank of Canada at the interest rate the Bank of Canada sets. Well, actually, not the one that they set, but they have another rate called the bank rate, which is the one that banks pay. But it's basically the same thing. And that's how they get their money. So the higher the interest rate is, the more that they have to pay to borrow the money, and then they're making a margin, right? Like, they're borrowing it at 6 and they're charging you 8. So they're making a 2% margin. That's what the banks in Canada and around the world do. So for them, higher interest rates aren't appealing either. So nobody likes high interest rates. And the people who hate the high interest rates the most are the people who are in debt. And the person or entity that is the most in debt is the government, right? Whether it's the government of Ontario or the government of Canada or the government of the United States or the government of New York, right? Those government entities are the things that owe the most debt by far. And of course, they're also the only entities that have some influence over the Bank of Canada or the Federal Reserve or the Bank of England, whatever, over their bank rate, right? So the pressure in the long term is for interest rates to go down. It's the reason why interest rates were so low just a few years ago, because the pressure is for interest rates to be low. And so we know, market trend, long term, interest rates will fall again. How long will that take? I don't know. If we go to war with with Russia, for example, it might take longer. The future is hard to predict. But what we do know is that's the long-term trend. So if you're going to buy properties today, you know that long-term interest rates are going to fall, right? And the property which was cheap today because the interest rate was high will now grow in price when the interest rate is low. And so you will make a return on equity, most likely, assuming you've chosen a market that long-term has staying power, right? If you're choosing a community that's going to shrivel up into a ghost town, that calculus may not work very well for you. So as an investor, there are rate hikes to consider, right? If you are looking to purchase a property, whether it's a fix and flip, a buy and hold, maybe it's a BRRRR, whatever it's going to be, right? When you go to purchase that property, you want to be aware of what the Bank of Canada is planning, right? If they say, hey, there's a rate hike coming in 2 weeks, right? Are you purchasing that property with a variable mortgage, with a fixed mortgage, or are you paying cash? If you're paying cash, then none of this matters. But assuming you're not paying, I shouldn't actually say that. So an important thing to think about if you're using cash, and I understand that cash is probably not what most of the people listening to this will be using, but still something important for you to know, especially, maybe 5-10 years down the line. I may not be here to tell you this, but you'll be in a position where now cash is important to you. So I want you to understand this. When you're using cash, that's fine. It makes a lot of things easier because it's cash. You must compare the cash value to its equivalent in debt. And what I mean by that is, if I have $1 million cash, right, and I want to go invest it in a property, and I find a property that is guaranteed it's going to make me exactly 5% per year. 5% on $1 million, $50,000 a year. I mean, it's not the most mind-blowing investment I've ever seen. In fact, it's a little on the tame side, but solid, right? If I do that with cash, there's a humongous opportunity cost because I could have borrowed that money and kept that cash and used it for something else, right? And so I always have to, when I'm making a decision about cash, I have to look at my alternative. What else could I have done with that cash? I don't need to look at all my alternatives, but just reasonable alternatives, right? What else could I have done with that cash that would have been productive, right? To say, oh, this is actually the right thing to do. Because just to go back to my example, my 5% property, right? Well, if I could take that cash, I know, for example, how to take that cash and privately lend it. Now, I can privately lend cash on real estate deals that I believe in almost 100%. Like that I have for me personally, I have assessed there's very little risk to these deals. That's my opinion, right? That pay 12%. So now I could take my $1 million and be making $120,000 a year on my 12% private lending deals, or I could be making the 5% on this real estate deal. And so now you see, okay, wait a second. If I could be getting 12%, I don't want to put the $1 million into this cash deal, even though it seems easy and straightforward and I'd acquire this property because it's only paying me 5%. I would prefer, right, the smart move would be, let's say, because I really want this property. Let's say I'm attached for whatever 5%. I'm not walking away from it, even though that number is kind of low. Well, if it's $1 million property, I could take $200,000 down, buy my property, finance the rest. Obviously, my returns no longer be 5% because I've got to pay financing costs. So maybe now my return becomes 0 or something like that. But now I own that property. And now I've got my $800,000 left over that I can privately lend at 12%, and I can happily collect almost $100,000 a year on that investment, as well as own the house. So it's very important when you're dealing with cash to think about it always against the alternative of lending, because you always have the option to. So it's always equivalent. You've always got to figure, am I better off to deploy my cash, or am I better off to deploy someone else's capital in the form of a loan, right? A very, very important thing to think about, especially, when you're thinking about rate hikes and things of that nature that are going to affect how much it's costing you to lend or to borrow, right? And obviously, if interest rates go up, right, then it costs you more to borrow. But it may also mean that it is more profitable for you to lend. So again, you may not be in a position to be a private lender at the moment, right? But you'll get there. If you're buying and selling real estate, it won't take you long to accumulate a couple $100,000 of equity that you could easily refinance and then lend to somebody, right? And I want to be very, very clear. I was just talking about how the banks work, right? That the bank is not actually lending you their money. They're borrowing it from the Bank of Canada, and they're making a margin, right? That's how the banks do business. You get to do the exact same thing, right? If you have a property that is costing you, I don't know, the mortgage is, let's say, 6.5%, right? It's a higher mortgage rate, but let's say the mortgage rate is 6.5% on your property, right? If you've got equity in that property, let's say $200,000, pardon me. You have $200,000 of equity in that property. Obviously, if you want to pull that equity out of the property at 6.5%, right, you're paying, what is that, $13,000 effectively to borrow that $200,000 each year, right? That's what it's going to cost you, right? But you could take that $200,000 and lend it, just the easy number, let's say 10%. 10% is kind of like the standard private lending amount. Like back when interest rates were 1%, a private lender was charging 10%. They're charging more now, but let's just go with 10%. If you're going to charge 10%, you're going to make that 4% margin. So you're doing what the bank is doing now, right? And obviously 10% $200,000 is $20,000. You spent $13,000 to finance it. So for you, you net $7,000, right? And actually, that's pure profit for you because it's lending. So you've now profited $7,000 off of that, what is essentially an arbitrage, right? That's what the banks do. That's what you can do. I probably wouldn't recommend getting started with private lending, just as an aside, with that small amount of money. I'd probably wait until you have at least $250,000 you don't mind locking up for at least a year at a time. Until that point, private lending is probably not for you. You can definitely do. I've written loans for $100,000, so you could start at that dollar amount. You just probably would have trouble finding brokers who take you seriously because you don't have a lot of money for them to market to their potential borrowers, right? And they kind of want to give. There are people who just need $100,000 loan to carry them over for a few months, and you can do those. But in general, mortgage broker is going to be looking for a one-stop solution for their customers, right? So since a lot of their customers are going to need more than $100,000, that means you're going to get overlooked a lot of the time, which means you're not going to be a very high priority for that mortgage broker, right? But it is possible to get started. If you want to get started with private lending, feel free to reach out to me by email and I can try and get you some more information behind the scenes. But B, you can always talk to a mortgage broker. Any mortgage broker will do. Not all of them will know very much about this topic, but all of them will know a broker who does, right? So you can get in touch with somebody who specializes in private lending, and they're always looking for lenders. And the only real requirement is that you've got cash money and you can prove it. And that you're willing to sign the papers and take the risk and work with the lawyers and et cetera, et cetera, et cetera. It's a fantastic. It's great to be the money man and just to make your points in the background and cash the check each month. And obviously, when you are doing that, the reason you're working with lawyers is because you get a lien, right? So you can take their house just like the bank can. So it's a great little gig. For you to be involved in, but knowing when to take which action is dependent on what the market is doing, right? Again, if there are rate hikes, right, that might mean you want to hold off on purchasing, right? It's hard to say. It could mean you want to hold off on purchasing, or it could just mean you want to look at a fixed rate mortgage, right? They're both possible. And it's going to depend on what your motivation is, right? Have you found the property that you think is a really good deal, a really good buy, even at its price or interest rate, and you're more concerned with locking that deal up, right? Or are you in a situation where you want to spend the money, but you haven't yet found the deal, in which case you're in less of a hurry to take immediate action and lock up a deal today, but you're just looking to get the best return on your investment, right? In that situation, if there are looming rate hikes, you probably hold off on purchasing, right? In the first situation where you've already identified your property, you know what you want, in that case, you would probably proceed with the purchase, but you would look at maybe a fixed rate mortgage, right? Something of that nature to hedge your bet, right? Finally, going back to, sorry, I'm jumping around a little bit here. I'm going back to knowing your market. So I talked about price trends and market trends, right? Interest rates, what direction are prices going? What is the central bank doing? Are there rate hikes, right? What are we expecting to happen and how that affects your decision making? The last thing is seller motivation, right? Understanding what is motivating your seller, right? Now, sometimes you're the seller and you need to understand what's motivating you, right? If you're selling, why are you selling? Are you selling to generate capital? Are you selling to liquidate assets? Are you selling to liquidate assets for the acquisition of other assets? Because those are two different things, right? So, for example, you retire. Maybe you'll sell some of your assets so that you can liquidate them so you have money to spend, right? And there is no goal beyond having the money to spend. So you're just trying to get the most bang for your buck, right? Conversely, maybe you're liquidating those assets because there's another asset that you want to purchase, right? You're trying to monkey branch or level up or whatever you want to call it, right? Go to the next thing. So now maybe maximizing your return is not the most important thing to you. Now there's just a certain return that you need to hit in a certain time frame, right? So that you can move on to that next asset, right? So that's going to be a slightly different motivation. There's, of course, the negative motivations too, right? You can't afford the place anymore, right? You're over leveraged, you can't afford the financing rate, et cetera, et cetera. So now you're selling to mitigate a loss, right? Or maybe in your portfolio, Interest rates increased. Maybe you've got 7 houses in your portfolio. Interest rates have gone up 33%. And now you can't afford the whole portfolio. So you're going to liquidate one property so that gives you a war chest for the next year to pay for the other properties while you wait for a more favorable market. Right. First of all, I hope nobody ever finds themselves in a position like that, because that probably means that you're over leveraged. But it does happen, right? And we're all human, so mistakes will be made. And over leveraging is certainly a common mistake that people make, because things are too good to be true. So people keep going, and even though they know that the good times can't last forever, they keep going and they keep going and they keep going until it blows up in their face, right? And we see this all the time. We're seeing it now. We saw for the last year, maybe, people who were going in, purchasing properties, and now they're getting burned because the good times could never end, even though obviously they had to, right? So you may find yourself caught in that trap. I know I've certainly burned myself. I mean, never massively, but definitely, there's a good thing and you keep going after it, and then eventually it's not so good anymore. I've had that happen with stocks. I've had that happen with cryptocurrency. I can gladly say I haven't had that happen with real estate, which would probably be the most expensive place for it to happen. So, but it, you get caught up, and you're not necessarily thinking straight, for lack of a better way to put it. I'm sure most of you can probably relate. so yeah. But understanding your seller motivation is going to be very key to making good. I shouldn't say it's going to be super key, because that's not necessarily true, but especially in this type of environment, it's going to be very important to your purchasing decisions, and I'll tell you why. Again, there's a lot of uncertainty in the market right now because of interest rates and blah, 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 right? And one of the things that is happening is those aforementioned people who got excited are being squeezed, right? There are people who are in properties right now where they paid 20% more than what the property is worth today, which means they are completely underwater, right? Their down payment is gone. There is no money. There's no equity in the property to save them. If they sold the property today, they would receive $0. They maybe even would stay in debt, right? There are certainly people in the GTA who would sell a home today that they bought last year who would still have a mortgage after you paid them for their property at market value, right? There are people like that. That's called being underwater on your mortgage. Obviously, that person is probably very motivated to sell. Now, it's going to depend, right? It's obviously their cash flow situation, et cetera, et cetera. But there are certain people who are being squeezed. They're motivated to sell. Now, the more motivated to sell that they are, then the more you can press them on price, right? Obviously, it's a market, so there's competition on price. So there are other people who are pressing on price too, right? Obviously, if you squeeze too hard, maybe they go with a different buyer. But it is important to understand, right? What's the position that your seller is in? What's the profile of your seller? Or what kind of seller are you looking for, right? As an investor, maybe you know that this is a rough market and you know that there are people who are getting squeezed, and your entire goal or strategy is to find those people, right? If you want to look at it negatively, you would say you're going to find those people and you're going to take advantage of their misfortune, their bad situation. And by all means, you're allowed to be a cynic and a pessimist if you'd like. If you'd like to look at it a bit more positively, right, then you're going to identify those people who got themselves in trouble, and you're going to offer them a lifeline, right? You're going to give them a way out. And yeah, of course, it's going to cost them, because whenever you make a mistake, it costs you. But at least you're there to save them from themselves, and they don't have to have, for example, the house be foreclosed and their credit destroyed. I mean, if you really just go through the thought experiment, if I was irresponsible, maybe irresponsible is not the word, I was over enthusiastic or over exuberant, and I purchased real estate last year at the top of the market, and now I need to sell it because I lost my job or blah, 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 whatever happened, right? And you come in and you say, okay, well, I can give you 25% less than what you paid for it, which means you're actually going to end up owing the bank, let's just say $50,000 after the sale, right? a lot of people look at that, especially poor people and people who will always be poor, will look at that and they'll say, oh, well, you're ripping that person off, right? And that's not true, but it's not entirely untrue. The problem with that style thinking is that it's not considering their alternatives, right? It's only considering a comparison to utopia, right? In a perfect world, his property is worth what he paid for it, and therefore you're ripping him off because his property is worth what he paid for it, but now you're getting it for less. We, of course, don't live in a perfect world. That's a stupid comparison, right? In the real world, the comparison is, of course, this is what he can sell the property for, right? This is what it is worth today. And his alternative is not selling the property and then letting the bank do what the bank is going to do. And what the bank is going to do, the bank is going to take that property. They're going to sell it. They don't care what it's worth as long as it covers their mortgage. There's not going to be any money left over for you. And now you're probably going to have to go through bankruptcy proceedings. And now once you've done that, for the next 7 years of your life, you're locked out of the credit market, right? And so if you, just to use an example, right? I don't know. Let's say you were 30 years old. You bought your first home and you did so kind of foolishly. And now it's cost you $200,000. It might take you 2, 3, 4 years. I mean, depending on how motivated you are to save up that $200,000 again. But it can be done, right? And it can be done a whole lot quicker than waiting 7 whole years for you to start establishing your credit again. I mean, we're really talking about you file for bankruptcy. It's probably going to be a decade before you can buy a home again, maybe longer, right? So you, as the investor who's coming in and quote unquote taking advantage, you're actually saving this person from a decade of waiting to play the game again. And so it's easy for a cynic or a pessimist to sit there and talk about how, taking advantage and this and that. And I think that's one of the true troubles in life is that you can see any situation glass half empty or glass half full. And we have a society full of people who like to see the glass half empty these days. They like to see the glass half empty in just about everything. And it's really unfortunate because they're not wrong, right? I mean, that's the great thing about glass half empty, glass half full. Nobody's wrong when they say the glass half empty or glass half full, and yet only one perspective is useful. In this case, positivity. That is, obviously, in terms of glasses, it doesn't matter. But understanding what your seller motivation is very important. Obviously, right? This the mindset or the motivation of your seller comes into play in a hot market too, right? In a hot market, interest rates are low, prices are sky high. Your seller is motivated by greed. They want to get the most bang for their buck, right? And they're going to do things to try to make sure that happens, right? They're going to hold off offers. They're only going to accept bids on one day, so they try and gin up a bidding war, right? They're going to market more aggressively, maybe work more with a realtor. A seller who is motivated by loss and fear and that sort of thing, they might work with no realtor, right? To take my example of the guy who's going to lose his $200,000. Well, if he works with a realtor, he's got to pay them too. They take another 6%. So now he's down 26%, so just 20. Right? So that gentleman might say, hey, if I could get this deal done without a realtor and save, 6%, potentially $60,000 to $100,000, right? On like a typically priced piece of property, right? They might do that. So understanding their motivation is important, especially for you as a buyer, because that's very, very valuable. Like one way to increase the value of all of your deals is to just do them off market. It's easier said than done, of course, but a realtor takes at the low end 4.5%, at the high end 6%, right? So in that range there, right? They're typically 5.5%. What a realtor takes, or realtors. That's the commission that they charge, right? And that gets it. This doesn't happen like literally, in the sense that nobody is like, oh, I'm selling a house for $1 million. Okay, I'm going to work with a realtor. Now I'm going to sell the house for $1,060,000. That's not what happens. But everybody's factoring that realtor cost into their price, and the price is that much higher. Because at the end of the day, if I'm selling my property, let's say for $1 million, and I want to receive $1 million, I need to charge the extra $60,000 because I got to pay the realtor to get to $100,000. Obviously, I'd have to charge even more because of taxes and everything. But just in theory, right? That's kind of how the math is working. So your all-in cost is including the realtor's fee. Pardon me. If you as a buyer understand that your seller is not super keen on working with a realtor, maybe you can establish a relationship with potential sellers before they've met a realtor, and you can be the person they talk to. Just avoid that realtor fee. That might save you $60,000 right there, right? On a deal, right? On $1 million property, that's $60,000 for sure, right? So that's something that's very important to understand is what is motivating your seller, because that's going to inform you of A, how to approach your seller, right? B, what they might be open to or what strategies they might be employing to maximize their position, right? Whether, again, they're being greedy or whether they're being fearful, right? And now you're coming in as the investor to capitalize on that, right? The last thing, and I've got to wrap up here because I have somewhere I need to be, but the very last thing I want to talk about is just when it comes to knowing your market is dealing with financing, brokers, private lenders, and obviously, mainline lenders like the big 5 banks. What rates are they charging you? What are you going to pay for money? What are other people going to pay for money? One thing to understand is that the market is not equal in the sense that people establish themselves in the market. Some people are more established than others, and they get different treatment, right? If you have an 800 credit score, you will be treated differently by lenders than if you have a 600 credit score. These are just facts. And one thing that you need to understand is there's the differential of opportunity, because you, with your 800 credit score, right, are going to get a better rate than the person with the 600 credit score, which means there's an opportunity, at least in theory, not always in reality, for arbitrage there, right? For you to be able to do things for cheaper than that person can, which allows you to either make more money or to make money off of them, or et cetera, et cetera, et cetera, right? So understanding what your financing situation looks like is very important. Every couple of months, if you're not actively looking for property at the moment, which is fine, you don't always need to be, but every couple of months you should be checking in with your mortgage broker or checking with your mortgage professional to see, hey, what rate would I be paying right now for money? How much is it costing me for cash? And that's helping you to make decisions. One, we were talking earlier about cash, right? And comparing cash against borrowing, which is something that we should always be periodically looking at the opportunity cost of using our capital versus using somebody else's, right? But B, especially with the interest rates moving around, right? The rate or price that you were quoted for borrowing 3-6 months ago, it might be out of date today. And so now you're coming to the market with out of date market knowledge, right? And that's giving you slightly incorrect calculations, right? Slightly incorrect maths. And that's telling you that your deals are worth less than they are or more than they are, and distorting your picture of things, right? So by keeping a dialogue open with your lending partners, again, brokers, someone at the bank, whatever it is, that is going to allow you to, I heard a ding, that is going to allow you to stay on top of things in the market and accurately value them for you, whether you want to acquire them, whether they would make sense in your portfolio, right? And that's a very important thing to do, because right now, right, as if interest rates climb further, right, then you want to know what is going to happen to you and your lending situation, right? Do you have variable loans or do you have fixed loans, right? And when are those loans coming due for refinancing, right? Because that's a consideration too. If I've got one more year at my fixed rate interest rate and then my interest rate's going to double, right? You need to do the math on that property and say, okay, well, in a year's time, when that interest rate doubles, am I going to be underwater? Am I going to be okay? Do I want to mitigate my risk somehow? Maybe sell the property. What can I do to position myself to have the most capital on hand possible? And so that's what you need to do, is stay on top of the financing, keep a dialogue open with your financial professionals. And obviously that's regarding just straightforward money, but there is also the private lender side of things. I was saying typically it's 10%. Can be more, could be 12, could be probably up to about 16% right now that they are lending at. And that's good to know as well, because that's also an option, right? And, a lot of the times, to establish what's called a bridge loan, right? Sometimes maybe you can't afford to purchase the property today. So you'll get a 1-year bridge loan from a private lender that's really expensive, right? It's not a rate that you would typically be willing to pay. Certainly not for 5 years or for the duration that you own the property, but it's another to set up the financing to have a traditional loan on it at the end of that year, but it allows you to purchase the property today because you think it's a good enough deal today or whatever, right? You want to have that today. So that's an option, and you can make lots of money that way. We've done deals where we were just closing multiple properties at the same time and couldn't afford them all basically at the same time. And so that bridge loan allowed us to financing, and then trending up. Our market was trending up and our rates were stagnant. We're able to actually make a profit, even though we paid an exorbitant interest rate by holding it for that year. So that's an option too, and something that you need to be aware of. So that's it. I'm gonna stop there. Again, thank you to each of you for joining. I hope it was insightful as always. And if you have any questions or comments, please shoot me an email, give me a call. You know how to reach me. Anyways, I'm available to you, and I'm happy to help. And we'll talk soon.